Hello traders, welcome to a mini-series on protective stops. Traders, in my opinion, most traders do not give as much thought to stop loss placement as they should. Most unprofessional traders are more focused on their entry and their take profit, which is one very telling reason why they are unprofessional. When in fact, placing a protective stop is your very first consideration a trader should take before they make any other decisions to enter the market. All successful traders agree placing a stop loss order on your open positions is the first and best defense against an unintended loss. A protective stop is only protective at the moment you decide to enter the trade, because at that point you have absolutely no control over what happens next. Your stop loss is at a point of the chart where you can no longer tolerate price moving against it, and as such should be at a price point of the chart that reflects your acceptable risk amount. Now, this much is known. The question is, how do you maintain your stop loss placement? How do you muster the confidence to hold your position through the normal ebb and flow of the market on our way to the eventual goal? I take the view that stop loss placements start out as a risk management tool at the beginning of the trade entry, because the outcome is completely unknown and out of your control. However, once price begins to move in your favor, they then become a profit management tool. And the only reason they should be used to liquidate a position is when something has changed within the underlying structure of the market. And following on from our previous discussion on protective stops, the question I get asked more than any other around this issue is, should I close out my position? Now, this question only arises obviously when traders see price moving against them. And the question itself has more to do with the individual trader's psychology rather than the normal price movement of the market. Now, the reason I can say this is because I have counseled, I have mentored hundreds and hundreds and hundreds of traders, and I can tell you that the defining pattern of these traders is that they are reactionary traders, meaning they make reactional decisions based upon their emotions, primarily because they are addicted to looking at their screens, and make irrational decisions based upon the natural ebb and flow of the market. They exit because they think they know what is going to happen until it gets to the point where they just can't stand it anymore, and they liquidate their position for no other reason than to give them some sort of peace of mind, albeit momentarily, because then they will go on and continue this cycle. Traders, do you think professional traders are caught up in this mental cycle of crap? No, they're not. They know where they should liquidate their positions. First of all, professional traders have placed their protective stop at an area on the chart where price has to prove them wrong. Meaning, if price hits their stop loss, their bias of the market has changed. The only time a professional trader would even contemplate exiting a trade prior to hitting their stop loss is based upon the price action of the market, not their emotions. For example, if you were short on a particular market and you see a well-defined counter-trend buy signal form, then you have a valid reason to exit your position for a limited loss. By the way, this has to form on, in my view, on the daily time frame. Otherwise, it's just market noise. Professional traders have learned to let the price action of the market tell them when they should take a voluntary loss if they happen to be on the wrong side of order flow before price hits their stop loss. We're going to discuss the only time you should exit a trade. So before we do that, let's just look at a typical scenario. You see a setup that meets your criteria, you've applied your strict money management principles, and you decide to enter the market. Great. So far, so good. Now at this point, you are emotionally stable. You are rock solid, if you like. Now that you are in the market, this is the time, the exact time, that most traders become emotionally unstable. A lot of traders suffer from this, and I know certainly in my early days, I most certainly did. Even though I did the work before I entered the market and applied a very strict set of rules, it seemed once I was in the market, all of my reasons for entering sort of went out the window, and I was constantly, if you like, mentally unstable, being anxious about the outcome of every trade. Now, I'm certain you can relate to this. I'm sure you have suffered from this at some point. This emotional shift from being stable and confident to being unstable and anxious started playing out in my head, and I found the need to interfere with my trade, and often resulting in exiting trades too early or letting trades run too long, only to see price go against me and wipe out my gains. Even though everything was fine upon entering, it was when I was in the market that things got screwed up. So if we know we've entered the market based upon our rules and we did everything we can to stack the odds in our favor, why do we feel the need to mess with our trades once they are live? Well, of course, there's lots of reasons for that, but at a fundamental level, it is simply this. The lowest common denominator is human emotions. Either greed kicks you in or pain gets you out. Simple as that, full stop. These two emotions are the number one driving factor behind you feeling the need to interfere with your, what you would call in-trade management. So what's the message here? If you exit a trade that is going against you without a valid reason to do so, before it hits your stop loss, you have taken a voluntary loss. Drill that into your brain, guys, because why on earth would you want to take a voluntary loss? So I guess the takeaway is you really need to understand that the only time you exit a trade, if price is going against you, is if the market gives you a sign, which would be a counter signal, that you should exit the market. Let the price action of the market dictate your decisions, not your reactive emotions. Should you move your protective stop? As I mentioned in the second lesson, the primary role of having a stop loss is as a protective tool at the beginning to minimize your risk in the event of a worst case scenario. In fact, it's more accurate to suggest your stop loss is a profit management tool rather than a risk management tool, because if you are sticking to a strict money management rules, your risk essentially is already managed by your allocated risk amount. So let's talk about using your stop loss as a profit management tool. Firstly, I am not a fan of having an automatic trailing stop loss. This is completely illogical, and more often than not, gets you out of the market prematurely, gets you out of the market too early for a small profit. Simply because you must give the market room to breathe. You must let the market do what the market does, which is ebb and flow. I am, however, a fan of managing the trade professionally and manually. When you exit is when you get paid. So I want to be in complete control of that myself. In my view, many traders are far too eager to move their stop loss into break even or profit territory for really no real reason other than their emotions are determining their actions. The only time I will move my stop loss is if the market gives me an opportunity to do so. Let me give you an example. Let's just say you are taking a short position on a particular pair, for example, and you've entered the market based upon your trading edge, and the trade begins to play out in your favor. Whilst that trade is playing out, you see another opportunity to again take a short position on this particular market. So when that happens, and if that happens, that is when I will move my original stop loss. Because I'm already in the market and I see another opportunity, in this case to go short, I think, where would I place my stop loss on this new opportunity if I wasn't already in the market? And at that area of the chart, that is where I will move my original stop loss to. It just makes sense. Now that may be into break even, it may be into profit territory, or you may not quite move your stop loss at this stage even to break even. That's fine. Should the market then continue in your favor and then you get another opportunity to enter the market, which isn't unheard of, another quality setup, then I will scale into the trade, but I certainly won't add to any positions until I've moved my stop loss at least into break-even territory so I don't double my risk. But of course, I can potentially double or triple my take profit. So the upshot of this, the takeaway is, don't be too fast to move your stop loss. Let the market tell you when you should move your stop loss. It does give you the opportunity. I've been in trades for a week, 2 weeks, and haven't moved my stop loss at all. There's no reason to, because the market hasn't given me an opportunity to do so. But if the market does give you an opportunity in the form of another setup in the direction that you are trading, by all means, then move your stop loss to where you would place that stop loss if you are entering on that new setup. It's just logical. It just makes sense. So the takeaway is, don't be too keen to move your stop loss. More often than not, just let the trade play out. But when the market does give you an opportunity, that is when you move your stop loss. And then, of course, if it gives you a further opportunity, you can scale into the trade knowing that you protected your first setup by moving it at least into break even or potentially into profit territory. Thank you, guys. Until next time, I'll talk to you soon. Bye for now.